Why the future feels so uncertain about money cold open right now. Somewhere in your city, someone just made a decision that affects whether you'll be able to afford rent next year. They don't know you, you don't know them. But what they're doing in a high-rise office, in a meeting you'll never attend, is mathematically reshaping your financial future. This is the part of economics nobody wants to talk about because it reveals something uncomfortable. Most of us are not in control of our own money. We think we are, we budget, we save. We make responsible choices. But the system running underneath all of that operates on logic that has nothing to do with whether you pay your bills on time or how hard you work. And right now, that system is doing something it's done maybe 5 or 6 times in the last 100 years. It's becoming genuinely unpredictable. This is why everything about money feels uncertain. And it's not because of anything you're doing wrong. The setup, why now let me take you back about 3 years. March 2023. If you were paying attention, you might have seen a headline. Bank collapses, deposits vanishing. It was phrased like a disaster movie, which it kind of was, except this time it was real and it happened very fast. Silicon Valley Bank. A bank that was handling the financial lives of thousands of startups and entrepreneurs. Assets around $140 billion. Liabilities $104 billion. On paper, it seemed fine. Then, over the course of 72 hours, around $35 billion left the bank. People panicked. They withdrew their money. The bank tried to sell assets to cover it, but the timing was terrible. The assets had lost value. By Monday morning, the bank was closed. The government stepped in. The FDIC moved in like someone stopping a fire before it spreads. But here's what made that moment historically significant. It exposed something that had been hiding in plain sight for about 10 years. The entire financial system is sitting on a foundation that nobody really believes in anymore, but everyone's pretending is stable. That foundation is something called confidence, not a mathematical principle, not a law of physics. Confidence, the shared belief that the system will work tomorrow the way it worked today. The reason 2023 mattered is that for a brief moment, people stopped believing. And when you stop believing, the math changes. Suddenly, $100 billion asset becomes worth nothing, not because its actual value changed, but because everyone decided it had. Since then, we've seen this pattern repeat in different forms. Economic growth slowing down, inflation bouncing around like it's written by a writer who doesn't understand continuity, interest rates rising in ways that make long-term planning almost pointless. Companies laying off hundreds of thousands of people right after announcing record profits. And somehow, the stock market is near all-time highs anyway. None of this makes intuitive sense, which is why it feels uncertain. The signals are contradicting each other. The old playbook doesn't seem to work. And everyone from the Federal Reserve to your financial advisor is basically saying, we'll figure it out as we go. That's not confidence, that's improvisation. The system explained to understand why this is happening. You need to understand how the whole thing actually works. And I don't mean in the theoretical sense. I mean the actual mechanism that connects your paycheck to the global economy. Here's the simplest version. Money is a story we tell each other about value. That's not poetic, that's structural. Unlike 100 years ago, money doesn't represent something physical anymore. You can't go to a bank and exchange your dollars for gold. Money is backed by the government's promise that it's worth something and everyone else's agreement that it is. That's it. That's the entire foundation. Which means the moment people stop agreeing, the whole thing destabilizes, not financially, narratively, but here's where it gets interesting. Because if money is just a story, and the story's power depends on everyone believing it, then the people who understand the story best have an enormous advantage. They can control the narrative. The central banks, particularly the Federal Reserve, are the main authors of this narrative. Their job is essentially to manage belief. They do this through interest rates. This is the mechanical lever they pull. Interest rates are the price of borrowing money. When the Federal Reserve raises interest rates, it makes it more expensive to borrow. When they lower them, it makes it cheaper. Simple. But here's where it connects to your life. When interest rates rise, people stop borrowing for houses, cars, business expansion, everything. Money moves slower through the economy. Fewer jobs get created. Or people stop spending because they'd rather put their money in a savings account and earn interest. Either way, the economy cools down, growth slows, and theoretically inflation goes down. When rates fall, the reverse happens. Borrowing gets cheap, money moves fast, everyone spends. The economy heats up, growth accelerates, but so does inflation, which is the secret cost. Your money becomes worth less even though you have more of it. For decades, the system worked relatively well. The Federal Reserve would watch inflation rise, raise rates to cool it off. Inflation would fall, and they'd lower rates to stimulate growth. It was like adjusting a thermostat. The economy cycled, but it cycled predictably. Then something broke. In 2008, after the financial crisis, the Federal Reserve did something unprecedented. They didn't just lower interest rates to near zero. They kept them there for over a decade. While they did that, they also started buying bonds and assets directly from banks. This is called quantitative easing. The idea was to inject so much money into the system that people would have to spend it, creating jobs and growth. And it worked, sort of. Growth happened. Jobs came back, but something else happened too. The money didn't distribute evenly. Most of that freshly created money went to people who were already wealthy. It inflated asset prices, real estate. Stocks, cryptocurrencies. If you owned assets, you got incredibly rich. If you worked for wages, you got a job back, so we ended up in a weird place. The gap between rich and poor widened dramatically. Everyone's purchasing power decreased as inflation crept up, but asset prices skyrocketed, creating the illusion that the economy was booming. Then inflation actually exploded. 2021 and 2022, prices were rising at double-digit rates. The Federal Reserve, which had been insisting inflation was transitory, suddenly had to admit they were wrong. They had to raise interest rates aggressively, very fast. This is where everything becomes uncertain. The uncomfortable math here's the problem that nobody in power is directly addressing. The economy has become dependent on cheap money. Cheap money is like a drug. You do it once, it feels great. You keep doing it because stopping feels worse. Eventually, you need it just to feel normal. After 14 years of near-zero interest rates, the entire economic structure is built assuming rates will stay low. Businesses took on huge debt because they could pay tiny interest. Governments did the same. Real estate became insanely expensive because people could afford bigger mortgages with low monthly payments. It all made sense when interest rates were near zero. Now that rates are much higher, the math breaks. A house that cost $500,000 was affordable at 3% interest rates. Your monthly mortgage payment was around $2,100. At 6%, the same house's payment jumps to $3,200. That's not a 10% increase in cost. It's a 50% increase for the exact same house. This is happening everywhere all at once, and the people most affected are people who are already struggling. Renters, people trying to buy their first home, small business owners, anyone with variable rate debt. Governments are in the same boat. Countries that accumulated massive debt during the cheap money era are now paying much higher interest on that debt. The United States government is spending around 6% of its entire budget just on interest payments. 6 years ago, that number was 1%. If rates stay high, interest payments will eventually become the single largest budget item, surpassing everything from infrastructure to defense to social security. At some point, the math becomes unsustainable. Something has to give. But here's the catch. If the Federal Reserve lowers interest rates to fix this problem, inflation comes roaring back and everyone's purchasing power drops. If they keep rates high, the economy slows, people lose jobs, businesses fail, and we potentially slide into recession, maybe depression. So the Federal Reserve is essentially choosing between two bad options and pretending there's a third option where everything works out. There isn't. This is what creates uncertainty. Not instability, uncertainty. There's no consensus on which bad outcome is coming or when or how severe it'll be, so nobody plans. Companies don't invest in expansion. People don't make long-term financial commitments. Everyone goes into defensive mode, which ironically makes the economy slower, which makes the bad outcome more likely. We're stuck in a logical loop. The system needs low rates to survive, but low rates create the problems that forced rates to go high, so rates can't actually come down without causing new crises. This is the opposite of the thermostat. The thermostat is broken, hype versus reality, so here's what's weird. Unemployment is near historic lows. The stock market is near all-time highs. And yet polling shows that 70% of Americans think the economy is either in recession or about to enter one. A majority of people report financial stress, anxiety about the future, and a sense that the system is rigged. These things are all true simultaneously. And that contradiction is the actual definition of uncertainty. There's the headline version of reality that looks fine. Unemployment good, stock market good, some inflation coming down, growth still positive. Technically, we're not in recession. Then there's the lived reality. People are working more hours for less purchasing power. Student loans are about to get called in from millions of people who paused payments during COVID. Credit card debt is at all-time highs because people are borrowing just to maintain their standard of living. Rent is consuming a larger percentage of income than at any point in recent history. And the strong job market is actually millions of people working multiple jobs because one job doesn't pay enough. Both narratives are statistically accurate. The stock market really is near all-time highs, and people really are struggling. This shouldn't be possible, but it is, because money is flowing to different places than it used to. The wealthy own most of the stock market. The top 10% of Americans own roughly 75% of all stocks. So when the stock market is up, the wealth gain is concentrated at the top. The middle class and working poor don't feel that wealth because they don't own stocks. They own houses and cars they're financing, and those assets are increasingly expensive while their wages haven't moved in real terms since 2005. This is why the system feels rigged. Because it actually is structurally, not because of some conspiracy. Just because the rules are designed in a way that wealth gravitates toward existing wealth and income-based wealth gets squeezed. The uncertain part is how long this holds. Eventually, when the squeeze gets tight enough, the narrative breaks. People stop believing the system is legitimate. And when that happens, everything becomes unpredictable. The bigger picture zoom out from the United States for a moment. The entire global economy is built on the same principle: cheap debt and the assumption that rates will stay low or go lower. This is true in Europe, Japan, China, pretty much everywhere that has a modern economy. Japan has been living in this world for 30 years. They lowered interest rates in the early 90s and essentially never raised them again because their economy was too weak to handle higher rates. Their government debt is now over 250% of their gross domestic product. In any traditional economic model, Japan should have collapsed decades ago. But they haven't because the narrative held. People kept believing in Japanese government debt. China is in a similar position but different trajectory. They've been using massive government spending and debt to maintain growth for the last 15 years, but that growth is starting to look artificial. Real estate is breaking down. Youth unemployment is soaring. The demographic crisis is kicking in. And their central bank is trapped. They can't raise rates without collapsing the economy, but they can't lower them without losing control of inflation and currency value. Europe is fragmented. Some countries can borrow cheaply, others can't. The euro ties them together, but the economic realities are pulling them apart. The United States is the least vulnerable because the dollar is the global reserve currency. Everyone needs dollars. But that's also a trap because it creates the false impression that the problems will solve themselves. They won't. What all of this means is that the uncertainty isn't local, it's global. And it's structural. It's not something that the current generation of policymakers can actually fix in a traditional sense. They can manage the symptoms. They can slow down the crisis. But the fundamental math that's broken requires a reset of some kind. The unresolved question, and that brings us to the question that nobody really wants to answer. What happens when the old rules stop working? Historically, there are a few precedents. Sometimes there's a period of controlled inflation. The government lets inflation run hot, which effectively erases debt by making the money less valuable. It's a tax on savings, but it clears the imbalances. This happened in the 70s, and it was painful but survivable for some people. Sometimes there's a deflation and a reset. The system collapses, assets become cheap, and new rules are written. This happened in 2008 for the financial system, except the government prevented it from actually resetting by bailing everyone out. So the debt remained, the imbalances remained, and the underlying problems got worse. Sometimes there's a currency collapse or a shift to a new system entirely. The British pound stopped being the global reserve currency after World War II, and the dollar took over. What happens when the dollar loses that status? Nobody really knows because it's never happened before in the modern era. What makes this moment genuinely uncertain is that we don't know which precedent applies. The The policymakers don't know. The economists don't know, they're guessing, and they're guessing while operating a system that affects billions of people. Your sense that the future is financially uncertain isn't paranoia. It's not because you're not saving enough or not reading the right finance blogs. It's because the foundation of the system actually is uncertain, and the people running it are improvising while pretending they have a plan. That doesn't mean collapse is guaranteed. Humans are good at muddling through, we've survived worse. But it does mean that the normal playbook, get a good job, buy a house, save for retirement. Follow the rules and you'll be fine. That playbook is operating in an economy that might be fundamentally different by the time you reach retirement. Maybe it'll be higher inflation, maybe deflation, maybe a slow decline, maybe something nobody predicted. The math is broken and no one's agreement on how to fix it without breaking something else that matters more. So when you feel uncertain about money, you're not paranoid, you're paying attention. The real question isn't whether the system is uncertain. The real question is, what do you actually want to do about it? Because the answer changes everything. And that's something no script can answer for you.